All right, good morning, everybody. Got a lot on the table today. Let me just check a couple audio settings really quick. This new OBS, I don't trust it. It keeps changing things, so just real quick. All right, that should do it. If you guys can hear me, then nice little thumbs up will be good, and we'll get started. Awesome, thank you, Matt. Appreciate it, buddy. So, a lot is going on. I wanted to kind of cover something from yesterday really quick, and this is not one of those bragging things, where we get to say, like, see, I nailed it, I told you. It's not that. It's more of the idea that you can see these things unfolding perfectly, just the way you would want. Yesterday at around 10:30 or so, I caught the green line crossover, something I've talked about numerous times. And so even while the market was still down around the lows of the day, I said, okay, I'm going to just call it like it is and say this is a reversal signal and one that I put a lot of faith in. I'm not going to go long just because I see this, but I'm now going to believe that a reversal is possible. And I want to start looking at a lot of other things right now and see if this reversal is going to take us back to the upside. One of the things that I would want to see is the ticks pushing into 800 at least once, and even better, a push into 1000 at least once. And the weighted AD needs to get above 0 and get at least to 500. It would be better if it gets above 500. So that's one of the things that I would want to see. Then we had this failed flag setup on the Monsters of Tech. I wanted to see that failed flag actually fail, start breaking to the upside and move towards the open. Then we had finance, needed to get back above VWAP, and even better, get back above the high a day. And then I wanted to see these advancing versus declining issues in the S&P and the NASDAQ really improve a lot more than this, right? They were just kind of barely breaking out above their own structure, and I wanted to see them really kind of take off. Laid out the S&P levels. This we had talked about yesterday morning, right? And the idea was that this is very likely our range, and we were going to hold the range until the econ. Well, if you're holding the range, that means you can't break down and set a new low. If you set a new low, you didn't hold the range. So when we were at the lows, we already had that expectation that we weren't going to break down and go lower, because the base case argument was we're going to hold the range, which means no going lower. But it also meant that we weren't going to set a new higher high above this gray box. So like I said yesterday, we might wick lower than the previous low, and it was during Globex when we were talking. It might wick down there, but it's not going to break down. And then we might retest the tops, maybe even wick out through the tops, but that we shouldn't break out and start running to all-time highs, or at least even back to these highs, because it wouldn't fit the waiting on PPI argument. Everything unfolded perfectly. Tested 800, tested 1000. AD crossed above the 0, expanded to 500 and then beyond. We got above the highest point of the day and kept expanding in finance. We had that failed flag set up perfectly in Monsters of Tech, and the weighted AD just kept on expanding just like we would want. So it just kind of shows the argument, right? That you can lay out a plan for the day, using nothing more than a drawing tool and a little bit of common sense, and maybe open, high, low, close, just marking off previous day's levels. We had a contagion event yesterday start to come across the world. Europe put out the message that they have until Friday to kind of resolve their pension liability issue. And that is what sparked the downturn yesterday afternoon, and yet we still maintained that range too, which is pretty cool. Now, the Fed has made it really clear they're not going to pivot, they're not going to slow down, they're not going to pivot, they're not going to pivot, they're not going to pivot. But they sent money over to Switzerland to cover a shortfall in dollar. They're participating in global events right now, getting ready for a just in case. Now, as much as they don't want to pivot, they may have to do something, and they have a lot of tools at their disposal. So if things start to unravel in the next 2 or 3 days, they may not pivot specifically. They may not come in and cut rates or come out and say they're not going to make a policy statement, but they don't necessarily have to. All they have to do is activate the plunge protection team and imply that they might do something. The something that they need to do is to get the dollar to back off. So watch our 10-year. Keep a really, really close eye on the 10-year. If it starts to get a little bit out of control, that's going to be the U.S. contagion that is really starting to get out of whack. You can see yesterday afternoon where it just broke up and started running. Now that's nothing. I mean, that's nothing. What we want to watch for is, say, this thing breaking up above 5, 5.5, 6. You know how absolutely insanely extreme that would be to see this just take off like that. So really keep your eye on the TNX today. Over through the rest of the week. Watch Finance Juice. I'm certainly not, trying to run a commercial for these guys, but if things are starting to kick off, you're going to see it here, right? And events from around the world are likely to come flooding in here, right? So you're going to see it here. Keep your eye on it. We are in a very unstable market environment right now. Global crisis on epic proportions. So yeah, no kidding, right? And by flash crash can go up too, not just down. So kind of keep that in mind. I'm not beating the drum saying, oh, we're going to go down. We can crash up just as easily. And the way that would kind of kick off is if the plunge protection team in some way implies that we are not going to get another 150 basis points between now and January, and they start unwinding some of this, that would be a massive spike to the upside. That would run over so many people who are just now finally getting convinced that they need to be short, right? So many people kept holding out for long opportunities, and they're finally going short. This would run them over to the extreme. We have the 10-year auction today. So we've got PPI. The last time we had PPI, the market dropped 120 points in an eye blink. And over the course of the next week, the market dropped over 600 points. So PPI is a really big deal in the current market environment, in the current situation. Today is not expected to be any different. So, be prepared for some pretty extreme price action. And then later in the day, we've got the 10-year auction, which honestly, I put it on the same pedestal and the same level as those FOMC minutes. At this point, those FOMC minutes are kind of a shrug compared to everything else that's going on. Tomorrow, we've got the 30-year bond. It's a wild and crazy week, right? Now, the Bank of Japan, U.S. dollar, Japan pair, the Bank of Japan is failing to keep that below the 145, and it's starting to pick up a little bit of speed. I know that that might not look like very much, but we're talking about rate of change. And believe it or not, so much of the marketplace is still focused on this 1970s math formula of rate of change. It's not like it was a new formula. It's just when rate of change really started coming into the space where people were talking about it more, from moving averages to RSI and stochastics and MACD, and literally the formula for rate of change. Momentum and trend are tied directly to rate of change. It's a big deal. We're picking up speed here. This is starting to represent that classic upside crash. So, most of the time people don't fear a market going up, right? Think about SPY or the Qs. You don't fear the Qs spiking up or falling up, but you do with oil, right? It would be a real big deal if oil suddenly spiked up. So there are, crashes to the upside that when you first think about it, it might not make much sense. But when you really start to ponder all of the things out there that you would be concerned about an upside crash, there's a lot of things out there. Now, melting up would be like a slow grind. Crashing up would be a 2 standard deviation, 3 standard deviation, 4 standard deviation moves to the upside. A parabolic rise, right? Like this, a rate of change that is changing exponentially fast, right? That's like a compounding nature of it. So it's on the deck for a number of things out there. It's a real critical timepiece. Look at the size of this candle and put it in relation to the previous candle. That's what, 0.32. It moved about 47 cents. And the day before, 0.39. Couple of, a little bigger here, 0.7. Okay. So these two candles were half the size of this candle, right? 3, 4, 5 days in a row, we had candles that were just basic, normal, everyday IX10 sideways, 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 sideways. We're starting to get a bigger candle. This one's not a big deal yet, except for where it is, right? It's above that 145. They're actively attempting to defend this level. They didn't slow it down. They didn't impact. Look, whatever they're doing, it ain't working. So really keep your eye on the dollar. Keep your eye on that 10-year. And remember, the entire world right now is putting pressure on the United States, saying, look, do whatever you can do to decrease the value of the dollar, to get that dollar down right now. It's crippling nations around the world. Get it down. Do what you can do. Well, they don't have to actively come out and make policy to make these kind of changes. All they have to come out and do is start talking about policy. They can start implying that they're willing to consider performing certain actions, and the market will begin pricing it in even before we get those actions. That crash to the upside that I'm talking about, if the dollar drops below, say, 110, especially if it's a very fast dollar, a very fast move below 1010, we could see the S&P and NASDAQ rip to the upside like a SpaceX rocket. Now keep in mind, I'm talking about the dollar and I'm looking at the DXY. The Dixie is not the US dollar. We kind of imply it like that and we talk about it like that, but this is a basket of dollars, right? It's got the euro in it and it's got all kinds of things in it. It's not just the dollar. So really kind of keep that in mind when you're wondering sometimes why this doesn't do what you think it should be doing, right? So on to today. There really is no reason to kind of game out what we think the market's going to do today when if the numbers come in hot we're very likely going to leg down below 35.5. That it's very likely going to be extreme. So this is the range that I had drawn yesterday using the Globex low, right? Because we do the morning briefing about 7:30. That was the low at the time. That was the high. We're still there. The argument makes perfect sense. Looking at the volume today, kind of asking the question, are we within our normal boundaries? Yes. We're not extreme and we're not overly light. So we'll just get that out of the way. And we are inside day yet again. Not much of a surprise. It's what we were expecting. That was the base case argument, that no institution or firm would want to really bring in a new asset or redistribute funds without knowing what's going on with the CPI. And so if they're going to wait, it made perfect sense that the rest of the market was going to sit on pause like we have here. September 13th was the last PPI. And it was a drastic, extreme move to the downside. And then it lasted even longer than that. It wasn't just that one-day move. By the time it was done, after the entire move was done, it was over 600 points. Well, if we extrapolate from our current location and make that same base case argument, you're talking about the S&P being down to 3,000 by the time we're done with this move. Because we're at 36, chop $600 off, or 600 points. It wouldn't be in one day, right? There's 913. It stands out so big, right? It's that really big candle right there. We had the move, and it just, look, almost no profit taking. 2 days of just slight profit taking. Otherwise, it was just pricing in all of that. Now, speaking of pricing it in, this is the November 2, and we're sitting at 3 right now. It's almost set into cement at this point that we're going to get a 75 basis point rate hike for November 2. Unless this contagion kicks off, right? And the Fed actually does pivot, which I'm not arguing they're going to pivot. I'm arguing that they might imply that a pivot is possible, and that's all it would take. But if that gets us to 375, when we look at December 14, going from 375 to what is the biggest price one, 4.25. That's a 50 basis point rate hike. So December's pricing in a 50 basis point. November is posting a 75 basis point, and February is a 25 basis point. Put all of that together, it's 150 basis points between now and February 23, excuse me. If they start pricing in another 75 basis points, this market is going to leg down significantly. And you'll see that they're pricing it in because this here, it will start to go down, and this here, it will start to go up. So that's what you're going to want to be looking for. They'll try to price 50 basis points into this. Actually, you know what? If this is 25, that's 50. There'll be a new column. So what you'll see is this one will go down, this one will go down, and a new column is going to pop up over here, and it's going to start to go up. So that'll be how you can tell if they are pricing in 75 basis points for February. For December, you'll see this middle column go down, and you'll see this right bar start to go up. And then, of course, for November 2, it already is sitting at the 75. The reason I bring up pricing in an additional 75 basis points is the consensus is that we were hot. And what I was reading is this Fed group who does the main consensus estimates, they're normally off. They come in low in their estimates. 15 out of the last 18 estimates that they've made. So if they think it's coming in hot and they're normally low, they lowball the number and they think it's going to be hot, it could be crazy hot. And if it's crazy hot, if it shows that the Fed has done all of this damage and all of this work and all of this pain and they're not accomplishing their goal, oh yeah, this market could make a significant leg down today. Now flip the script on all of that. What if it's not? What if it comes in weak and it shows that they're doing a really good job, a bang-up job, and that they're accomplishing their goals? We could get an unprecedented move to the upside today. And that's setting aside all of the contagion, the FX markets, the whole Euro Asia mess. It's setting all of that aside and just talking CPI. We've got an ADR right now of 2.5%. If we were to measure out a 4% move, we've seen a number of 4% moves this year. That would take us up to 37.60. The previous week's high is 5.5%. I say if we come in soft, we could tag previous week's high today. More than likely, we would make it up to 37.60 area. That would be the 4% move. 4% to me is more realistic than the 5% move. 5.5%. It would also continue if we were to get that good number for the market and we make that move up, just like when things were bad and it stayed bad for nearly a month. I believe the same would be true the other direction. That we could easily start that. We need that higher high, right? We got to get higher than this high. So we would get that higher high, and then we would start to challenge the 4,000 area. Now, trust me when I say I'm not talking about going back, to 2020 highs or anything like that. 4,800. We're not talking about that kind of stuff. We're talking about 39, 41, maybe 41.5. If we actually broke above 42, that would change dynamics that we shouldn't be changing. And I think that's off the table. I don't think we're going to get higher than that pivot. But certainly we could get into 4,100 before things start to calm down again. So certainly something to keep in mind for today, right? It's not all doom and gloom to the downside, except that so many people are finally short. Took them forever to finally get convinced that you need to bear up. But can you imagine finally going short and then getting your face ripped off with this upside move? That would suck. So we've got our upside argument. At least a 4% move today if the numbers are good to the upside. So let's make the argument for the same direction to the same distance to the downside. 34.60. So now we've got our argument in place. And it really is that simple, right? We don't have to sit there and try to grind out and game through all of the possibilities. None of this will matter. Volume profile, volume nodes, volume resistance, point of controls, value areas, and none of it's going to matter. It'll blast right through all of that like it's not even there. Now in the retest, once things, when in the first whiplash and then things start to calm down, then it might matter, but certainly it won't matter in the first push. For those of you who use flow tools, say like Bookmap or Jigsaw or something like that, record the CPI and the PPI report. Record the flow. You can use OBS, it's free. You could use Zoom if you've got it installed. You can record your screen with that. Record the screen so that you can go back and watch it in slow motion. I've done that with using Jigsaw. The orders come in so fast that there's nothing there. Like price is at one spot, and then seconds later it's literally way over somewhere else, and it didn't move there. It teleported there. Poof, it's just in another spot. But you can slow down the tape depending on your recording studio to a tenth of a second. Now, a tenth of a second, that's really slowing things down. Lock limits would be 7%, right? So I don't expect to trigger lock limits in the first whip, but we could trigger lock limits through the day if the XF contagion comes into play as well, right? Because right now we're just talking CPI. But remember, we've got the 10-year auction today, and we got FOMC today, and we have this whole situation with the British pound and the Euro-Asia FX crisis and the pension funds and the, right? Take a breath. There's a lot that could really go wrong today. So there are lock limits for the market, but they're at 7 plus. So, CPI alone shouldn't trigger shouldn't quote trigger the lock limits. And it's a little weird how they do the lock limits, because the limit setting starting point is yesterday at around like 3:30, 3:45 kind of thing, right? Like that always threw me off, because it's like, where do you start the measurement for that 7% move, right? And yeah, it's based on that logic. Odd. One of the things that is scary is that during power hour at 3:30 they remove the lock limits. There is no safety net on the market at 3:30. And well, 3:30 depending on your time zone. So in the later part of the day today, we're getting FOMC at 2. If it starts to pick up speed into 3 o'clock and then we get into 3:30 and we have no safety net, I mean, it's always seemed like a really bad idea to remove the darn thing. It's like taking your seatbelt off when you're still 2 miles from home after driving 50 miles wearing your seatbelt. You get 2 miles away and you take the seatbelt off. Why? So taking the safety net off at the end of the day just doesn't make much sense. But they petitioned for that. That's not a normal thing. At some point they're going to put it back into place. Yeah, the banks asked to have it removed. So honestly, guys, that's what I got for you. There's no reason to, bang our heads. Now, if you want to walk through this a little bit, yesterday, that reversal, and it's what we all try to catch, right? All the time. We're always trying to find a way to validate and confirm and trade with conviction this kind of reversal in the market. I take pictures of this cumulative tick all the time. I've been using it for a few years now, and at first it was like trying to read tea leaves in the bottom of a cup. I mean, I didn't get anything out of it. But after a while, you really start to learn to watch that green line. And it's been wrong, or it's led me astray before. It's not perfect. Nothing is. It doesn't always mean that the reversal is going to be solid or that it's going to work. But when that green line deviates from the group and starts running, that's usually a change in market structure. So that move to the downside, I had every expectation that the S&P was going to maintain our range that we had talked about yesterday. So as we came into the low of the day, it made sense that we were going to hold that low and that we weren't going to break lower into a new low. So this green line crossing up was a nice validation of my bias that I already had, that we were going to hold these lows. So once we had the bias and we started to get the confirming signal, I started laying out the argument for, well, what else do I need to see before I'm going to trust this enough to put money in it? Now, for the futures, that's not a big deal because you can just jump in and out all you want. No PDT, the commissions pretty much pay for themselves with a couple of ticks. So it's more of the option side of things, having enough conviction in it, because the options, they're not going to move penny for penny with price. They're going to take volatility crush. There's cost to carry just to get into the darn thing. You start out in the hole in an options trade, whereas in the futures, your hole is commissions. Pretty easy to get past. So how do you find conviction to get into the trade for the reversal? You have the bias, you have the first signal. I wanted to see these really begin to change, and that I took a picture, because that's how you go back and study this later on to learn to train your brain to look for these things. We had just started to break higher than that high. And we had just started to break higher than that high. We were kind of coming up through there. So that was a good step. We wanted to see an improving market breadth. We wanted to see the financials, which was struggling with VWAP at the time. They just couldn't get through the darn thing. They needed to get through it. Then they needed to get above the high a day. Then we would know that we were working with tech and finance, not tech versus finance. So we got above that. We had the improving breadth. We had the monsters of tech with that failed flag play. Now at the time, we had not yet gotten into 800, and that was one of my benchmarks. And it'll work the same way for a downside move if you're trying to validate a trend reversal or a midday reversal from high to low instead of low to high. Pushing into 800 at least once, or minus 8 if you're going the other direction. Pushing into 8 is kind of a confirmation that the strength is there, that there's actually some inertia behind these moves. Right? So I wanted at least one 800 touch, which we picked up. And then an even better one would be hitting the 1000, because to get to 1000 we would have to hit 8 again. Multiple touches of 8, that's good. That's a good solid bullish push. Just constant buying under the surface. So another 8, another 8, 1000. That's what we want to see. Now, everything that I've been talking about so far is free indicators, things that either I created or they already existed. This one is not free. I didn't create it. I can't share it because I'm not going to get sued for sharing some indicator that I didn't make. That's the weighted AD. At the time, it was still below zero. It was still down here. We wanted to get it above zero first, and then we wanted to see at least 500 and an expansion beyond that. But getting above zero would be the first touch, the first validation piece. Getting to 500 would be the second, and then expanding above that would be the third. And it's called the weighted AD, but it's not advanced decline. It's actually weighted sectors versus unweighted sectors. So a little weird. The name kind of throws it off. And when you put all of these pieces together, you start to have the conviction to play that reversal. And then when it all starts to go to hell and unravel again, like when it all started to fall apart, all of those signals that we look at, I mean, they were glaring and obvious. Look at the way that that green line just turned around and started heading down. Breadth reversed. Ticks reversed. Now, the rate of change on the reversal was significant. The reversal wasn't a surprise. We kind of already knew that there was going to be a reversal, but it was a little early and it was a little faster than we had anticipated, right? Because that was our range yesterday. Now, the reversal, love this. During the day, I tend to use the SPX more than the ES for evaluating what's going on in the S&P. The reversal in the SPX timed perfectly to the tick to an open high-low close, which is why I talk about all the time when we get to one of those spots, we don't use language like it's going to reverse there. That's the wrong way to say it. We use language that says if we're going to reverse, this would be a place where I would expect that to happen. So here's the close. Here's where we stopped. Now, I didn't know it was going to turn right there. Certainly didn't know it was going to fall in hard and as fast as it did. But as we come up into the pivot point, as we come into that, you got to use the language that says if we're going to get a reversal in the market and start to go back down, this is where it could happen. If we go through it and we get above it and that old resistance becomes support, then we focus on the next level. And we say, okay, it didn't happen there, but the next place it could happen, 36.47. And then, of course, if we manage to get through that and it becomes support, then we focus on the next one. And we just keep working through our levels, right? One level at a time. Even getting up to that level, I used the same thing all the way up. First, we had our own open, right? So it's okay, well, if we can get through our own open, then where are we going to go? To the close of yesterday. Okay, and if we can get through the close of yesterday, then where are we going to go? Right? And just keep working the levels. Next one, next one, next one, next one. Each one of those was a place where we could have reversed. And it finally did reverse off of the close from Friday. So when the market behaves the way that it's supposed to, like yesterday, you can have some pretty good trades. And I'm pointing all this out because I seen someone yesterday complain really bad. I mean, they were really frustrated and said that what a horrible trading day. That's what they said. Oh, it was such a horrible trading day. And I thought, man, perception. I thought yesterday was absolutely awesome. It was a beautiful trading. It was great, because price actually did behave normally, except for that extreme rate of change into the afternoon. We knew it was going down, but yeah, that was crazy. All right, everybody, buckle your seatbelts, right? It's going to get a little wild today. Just please be careful. Watch the other markets. It really doesn't matter what you trade. Whatever you trade is not trading in isolation, right? You're not trading alone. Facebook's not alone. Google, Microsoft, Amazon, these things are not by themselves. They move with their peers. They move with the broader marketplace. Everybody be safe. I will see you all tomorrow.